Welcome to the Charleston CFO Council. This organization was co-founded in 2015 by Robert Bendetti and Mark Carmichael in order to provide a networking and educational forum for senior financial executives to share best practices, to discuss current financial issues, and to learn about current topics related to the performance of their job.
Well, good morning, everybody. Thank you all for showing up. I'm going to go ahead and get this started. And I've got some light introductions of the CFO Council, and then I'm going to introduce our speaker and sponsor. I'm super excited about this one. I have listened to Scott Clemens on TV several times, so I got excited. And my wife told me that Scott's more interesting than me, so I need to shut up and be quick with my intro. So I don't know if I'm going to actually listen to that, but that's at least the goal. All right, Bill. Ross,
all right.
Sir, with Brown Brothers and Harriman, thank you very much for being our sponsor today.
Absolutely. Good morning. I am Phil Ross. I'm a corporate advisor with our firm out of our Charlotte office. We spend time with business owners all over the Southeast and especially the Upstate and in Charleston, and had the privilege to speak to the Upstate CFO Council last year. And originally for today, we were going to do an M&A related discussion panel. But given the current environment, I thought it'd be a great time to introduce Scott and have him speak about something that's a little more timely, which is the economy and public markets, especially during COVID-19. Looking forward to getting back together with you all at some point in the future. And if we can be helpful to you, please let us know. So with that, Robert, I'll turn it back over to you to introduce Scott.
Phil also has some of the best swag. You were a sponsor of one of the Upstate meetings a few months back, and you set the bar pretty high. People start expecting our sponsors and speakers to bring stuff to the meetings for Q&A. So you need to tone that down. Yeah.
Good memory.
And I think I stole or won a couple of those hats, and I used them for my marathon training. So yeah, you have great hats.
I think I remember your phone finding its way into my bag too, and having to meet up with you afterwards.
It's crazy. You and I have the same backpack, and exactly. I threw my phone at a black backpack behind the screen before I got started, but it was accidentally yours, and I had to use Google Find to track my phone down. And I was standing 3 feet from your car.
You work for a government contractor, Robert. I think you had some special tracing technology.
All right, Scott, you're about to get unmuted. So Scott is the chief economist, investment strategist, and a partner at Brown Brothers Harriman. Is that true, sir?
That is true. Guilty as charged.
And you got your undergrad at Princeton, bachelor's in the classics.
True.
And normally I would give you a hard time about that degree, but I got in this weird rabbit hole looking into your background and watched like 2 videos and 3 articles about your passion about classic books. So now I'm super interested in classic books, and you're at fault for this. But I believe you are a lover of the classics and a member of multiple societies, including the Bibliographical Society of America and the Growler Club. Is that true?
Growler Club, that's right, yep.
And that, it seems to be a private society for bibliophiles, a research library, 100 years old or more for book lovers in New York.
That's right, yep.
And is there not a secret staircase hidden behind a bookshelf?
There is a secret staircase in our library. It's not terribly secret. Everyone knows where it is, but it's a hidden staircase, put it that way. And I would say before you get there, the Grolier Club of New York City, although it is a private club, it is open to the public. There's a main exhibition gallery where we've always got an exhibition open, not now for obvious reasons, but when we get back to normal, if any of you find yourself in New York, please come find the club. It's on 60th Street, just between Park Avenue and Madison. And we are open 6 days a week, free of charge to the public to come to the main exhibition gallery. Ask for me. I may very well be there.
And did you write a book on a fellow paisano, Aldous Manutius?
I did indeed, about 5 years ago now.
Save the Western Civilization?
Yep.
Excellent. And I watched a presentation you gave on that book and how it's how that man saved the Western civilization, and that was really fascinating. And I think there's, as we're on new technology, and how this WebEx it's simulating a conversation. I found some parallels to how that and the printing press, seems familiar. It makes things more accessible, and how it's just a different type of innovation in marketing. But I found some cool parallels, and it's fun. I have some strange passions and hobbies, so it's always cool to learn a little bit about somebody with new and different passions and hobbies. Last thing I found, this is my son, and he's a teenager, so take this as a compliment, recommends your Twitter feed, that there to be found financial information, book recommendations, and I quote, the mating dance of turkeys.
There's something for everyone on my Twitter feed. Yeah.
All right. Well, you heard it here first, folks.
So the one thing, Robert, that's great internet research. Thank you for that. I'm flattered. The one thing that you missed that I want to observe is that my interest in early Italian printing led me about 5 or 6 or 7 years ago, now I can't remember, to actually give a lecture at the Charleston Library Society. So I spent a couple of days in Charleston and got to meet a delightful man that I'm assuming some of you knew, Stephen Gates, who at the time was the president, I think he was the president of the Charleston Library Society, and had the even greater pleasure to stay in his home, one of those great old Charleston homes right downtown. Those of you know Steve know that he passed away, I guess 3 years ago now, and I miss him. But I'm a big fan of Charleston, a big fan of the Library Society there as well. So when Phil and Robert asked me if I would do this, I leapt at the opportunity. So thank you for that. What I thought I would share with you is what we're sharing with our clients at Brown Brothers Harriman. Many of our clients are private business owners. They're interested, obviously, in economic material. They're interested in what's going on in the labor market. They're interested in how businesses are responding to COVID-19. And so this is the material that I've been sharing with our clients. We're also investment managers. We share, we manage portfolios for many of our clients and do asset allocation. So in the back of all of this, there's kind of an investment viewpoint as well. I'll touch on financial markets at the end, but most of what we'll cover today will be on the issue of economy. Let me see now if I can forward the slide. You know, Robert, you might have to take back control and just forward for me if you don't mind.
Sure.
And I'll guide you. It's pretty straightforward, right? So just a few insights into the COVID-19 issue itself, and I won't dwell on this because you are all inundated with information about this. But I just want to show you what it is that I like to look at. I like to look at this on a national basis, on an international basis, and on a state-by-state basis. What you're seeing here is the history of COVID in the United States. The left-hand axis in red is total cases diagnosed, and it's shown on a log scale. And the reason I do that is it makes it very obvious very quickly what the growth rate is of the disease or the cases diagnosed in the United States. The idea of bending the curve, it's this curve that everyone's talking about. The flatter this red line is, the flatter the growth, and we get down to sort of a zero case type count. The blue bars on the right-hand scale are the literal day-to-day count. There's good news on this graph. Obviously, that curve, the red curve, is beginning to bend. And when you look at the daily case count in the United States, it appears to have peaked in early April, and not in a straight line, but with some variability heading down. If you go to the next page, however, page 3, there's a little bit of a sobering insight here, in that what's really going on is that the epicenter of the crisis in New York and New Jersey and Connecticut, that sort of very dense urban area, that's really where the improvement is taking place. So if I back out of the US data, those 3 states, a similar type picture, but with some subtle differences. First of all, the curve is not flattening as quickly, and the peak in daily case counts appears to have been in the very recent past, just 3 or 4 days ago. And with the variability of the daily case count and with the variability of testing, it's not altogether clear that we've quite turned the corner yet. again, outside of the tri-state area, which was really, I think, in retrospect, going to turn out to have been the epicenter of the crisis itself. Robert, if you go to the next page, this is just a snapshot of the database that I keep to look at state by state to help me determine how quickly some states can get around to reopening. Data is pretty straightforward. I'm happy to provide it for any other state if you'd like to see it. I've highlighted South Carolina there for obvious reasons. Total cases per 100,000 people. That's important because obviously populations differ. And then the daily growth rate. The following column, days to double, I put in there simply because the daily growth rates can be deceptive. So when you look at the bottom, the US daily growth rate has dropped to 1.9%. That sounds like a really low number, but you all know how compounding works. A 1.9% daily growth rate translates into a doubling in US cases every 37 days. Peak daily cases, the date of the peak state by state, and the days since the peak. Seems that South Carolina peaked well over 4 weeks ago, or almost 4 weeks ago. That's not true of every state. California has seen an outbreak again. North Carolina seems to still be rising. Not big number of cases in an absolute sense. This is the kind of data that I use to keep track of how quickly states can and should reopen and whether or not we can begin to get the economy back on track. One of my favorite high frequency data points is on the next page. This is data from OpenTable.com, the online restaurant reservation site. And OpenTable shares their data, and you can actually track and see restaurant reservations city by city on a year-over-year basis. It was fascinating a month and a half ago to watch this data and watch the economy shut down in real time as restaurant reservations fell to zero or fell 100% year over year in every city, in every state in the United States of America. But look what's happened just over the past week or week and a half. Some cities, Georgia, Texas, and Florida, people are going back to restaurants. Not many, admittedly. I don't want to overstate this, but they're not down 100%. Every other city still is. And I love this data because the challenge that we face as economists, particularly in a rapidly moving environment like this, is that so much of economic data is backward looking and lagged. To be able to look at some close to real-time data like this is quite remarkable. And I think we'll see in this evidence of how economies begin to reopen in far realer time than maybe top-down economic data can provide. Before moving on to some economic observations, let me stop there, Robert, per agreement, and see if there are any questions that have come up so far.
Yeah, we did have a couple questions. One was when you discussed the slope of the curve and how we hope it might be flattening. Originally, there was talk of if we could stay below capacity, then commerce could continue. And so how does the actual line and the actual slope and compared to capacity, how does that compare with the original projections of what we were hoping for when they used to show those graphs a couple months ago?
Yeah, it's a good question. And 4 or 5 weeks ago, 6 weeks ago now, I guess, if you think about what the narrative was, we were talking about field hospitals in Central Park and refrigerated trucks to handle morgue overflow and hospital ships. And I mean, the evening news sounded like a wartime footing, and I guess it was to some way. There's a path to getting back to economic activity well before there's a vaccine. And that path involves frequent testing so that you can rapidly intervene and isolate. The surge on hospital demand 4 or 5 weeks ago was people showing up at the emergency room having had COVID-19 for 2 weeks. So well into the disease with no intervention whatsoever, even common flu remedies. And going from the emergency room to ICU to intubation to a fatality. The sooner that you can identify someone well before they're symptomatic, isolate them, stop the spread, you reduce the burden on hospitals. And I think we're at that point. We're at least at that point for the summer. Of course, as you all know, one of the big debates that remains to be seen is whether there's a seasonality to this virus, like there is many other viruses, in which case the fall and the winter of this year might pose a bigger threat than the summer months. We don't know that. We'll see.
Another question was around, you noted some metrics in the previous slide around days to double. As financial folks, are there any metrics we should be looking at with this type of data, any COVID data that would be a leading indicator to the economy reopening, or you could see as having a significant impact on business?
Well, you will remember maybe 3 or 4 weeks ago now, the White House released a set of guidelines acknowledging that states and regions were going to implement those guidelines at different times and at different paces. But those metrics required measurement of flu, three things: measurement of flu-like symptoms, actual diagnoses of COVID cases, and what we're just talking about, hospital capacity. The idea that the White House put forward was that if all three of those measurements continue heading in the right direction for 14 days, then open the valve of economic activity a little bit, not all the way. 14 more days of success, open it a little bit more. 14 more days, open it a little bit more. What we're seeing, of course, is that patience is not necessarily a widely shared American virtue, and some states are accelerating that dynamic. Now, the good news is that those states are providing sort of an unintentional experiment, I think, for the rest of the country. So we're watching, South Carolina is one of them. We're watching Georgia, Texas, Tennessee tend to be the states that are at the forefront of this. If these unintentional experiments work, if they are able to reopen without big demand for hospitals, without big rises in case counts and fatalities, I think other states will learn from that. Other states will get jealous from that and probably accelerate their own plans. So I would watch those 4 states, including your own, very closely, because I think they're going to end up being leading indicators for the path that the rest of the economy nationwide takes to open up again.
And then, Scott, you mentioned data. We all need good data to make decisions. Have you seen any indication, you don't have to be specific, but of when we compare ourselves in any countries, not to be named, maybe underreporting? And have you ever seen any indication that there might be over-reporting in U.S. hospitals because of the 20% premium they might get on Medicare patients?
I can only speculate on that. I don't have any inside information. What I will say is that my gut feeling, and this is, I think, particularly true in New York, that if anything, the actual incidence of COVID-19 is understated. At least in New York, the greater New York area, 3 or 4 weeks ago, when the hospitals were in danger of being overwhelmed, if somebody showed up with COVID-like symptoms, they did not bother to test them. They went right into therapy, right into intervention, rather than waiting for an actual medical diagnosis. They relied on a clinical diagnosis. You have the symptoms, then come over here and we'll take care of you. So those, to the degree that those wound up in fatalities, they were not reported as such because there was no medical diagnosis, only a clinical diagnosis. So, I don't know the answer to that because there's so many trends pulling in so many different directions. I think certainly in some countries in the emerging world, and I think China is one of them, the case count there is almost certainly understated simply because many people didn't even seek medical care. They chose to remain at home, and that may have cost them their lives, and those wouldn't have been reported either. So I don't know the answer to that question. I'm not sure we'll ever know the answer to that question because the trends pull in so many different directions.
Okay. I've got a bunch of other questions I'm going to hold, and I'm going to advance to the next slide, Scott. Thank you very much.
A couple of snapshots on the economy itself. This is the one area that I focus on is the labor market because it's so important for the rest of the economy. The linkage is important. 68% of GDP is personal consumption, spending decisions that all of us make on a daily basis. So the big reason why GDP is under such stress is because we're not spending money. We're not spending as much because we're not going out to do so. So we are watching the labor market in particular because the labor market determines not only the ability, but also the willingness of people to spend money. What you're looking at is the April jobs report, and it's just staggering. 20.5 million jobs lost in April alone. I've circled the global financial crisis because otherwise it's becoming hard to see. It looks like a little blip, didn't feel like a blip at the time. But that 20.5 million jobs lost in April compares to 8.4 million jobs lost during the entirety of the global financial crisis. So this is a staggering, unprecedented, sort of literally off the charts type development. Go to the next page, Robert. It's driven unemployment up to also historically high levels. What's most remarkable about this chart is not so much the 14% unemployment rate, but the fact that in February, 2 months prior, unemployment was 3.5%. That was a 50-year low. We went from a 50-year low to near an all-time high in 8 weeks. And that just underscores the rapidity of the onset of this crisis. What worries me, Robert, if you go to the next page, there are various measures of unemployment. So the headline rate, the red line here, is the one you see in the headlines, hence the obvious name. But there are other ways to slice and dice the data. The unemployment rate for people with a college degree or higher is the green line. Jumped a lot, but 8.4%. That's not a catastrophic number. What worries me is the blue line, a broader measure of employment that takes into account discouraged workers and part-time workers, leapt to 22.8%. And it underscores the fact that the real burden of this labor market crisis is falling on blue-collar workers and workers who, let's be honest, don't have the ability to work remotely. I'm a white-collar job, professional job. As long as I have an internet connection and a laptop, I'm good. I miss being on planes and visiting clients, but for now, I'm good. I can keep my income, I can keep my job, I can keep my spending. I worry about this because it begins to accelerate that gap between wealth and income that's been a problem in this economy, and it's likely only to continue to grow. The good news is, if you go to the next page, part of the employment report asks people who lose their jobs, do you believe that your job loss is temporary or permanent? And if you look back over time, this goes back almost 50 years, a little over 50 years, somewhere between 10 and 15% of the time, people respond and say, I think that my lost job is temporary. The factory is closed for a fire, or it's a seasonal issue or something like that. What gives me some confidence is that in April, 78% of people who were out of work said, I believe that my job loss is temporary. It doesn't mean they're right, by the way. It doesn't mean that 78% of those jobs are there. But the mindset of that, of this is a temporary pause, I may be on unemployment, I may be on the Paycheck Protection Program, but that job will be there when I go back. So I'm not sure what we're looking at is a genuine loss of jobs as much as a temporary pause in jobs. What further underscores that on this next page, if you look at weekly unemployment claims, this is the data series that comes out every Thursday morning. It's an early insight into what's likely to happen with the labor market. Early in the year, weekly claims for unemployment were running about 200,000, a little over 200,000 a week. But look what happened in March, 3.3 million, 6.9 million people the third week of March. But since then, 5 weeks in a row, that number has come down. You may accuse me of being a glass half full kind of guy, but economies depend on trends. And the trend in this number is in the right direction. I don't think we're going down to 200,000 anytime soon, but we're not adding even more to that unemployment rate. This is the biggest economic bet on the table, I think, and it's very tightly aligned to what we were just talking about, the speed with which economies and states can reopen. Because if those jobs are genuinely there when people go back, that's less and less true with every week and every month that goes by. The sooner we can reopen, the sooner we can reopen safely, the sooner we can look in the rearview mirror and say that whole job loss thing in the spring and early summer of 2020 was genuinely an anomaly and not a significant impairment to underlying fundamental economic activity. Let me stop there again, Robert, and see if that provokes any questions before we go on.
Scott, there are several questions around the additional unemployment insurance that is available to folks and different classes of folks than normal over a 4-month period. I'm going to break them. I'm going to pick one of the questions, and it is that there's a company that within the council, many of their entry-level positions they hope to hire for start at less than $15 per hour, and they are getting little to no traction finding applicants, even with massive unemployment. And you can kind of understand it if you can do math. You can get more on unemployment than you can for working. So you got to kind of respect them being able to do the math. But how do you see that having that unintended consequence maybe over the next 3 or 4 months that people can get paid more to not work? How do you see that impacting recovery?
Well, it's certainly an unintended consequence. And yes, Robert, people do the math. And the math is that in many states, the sum of the state unemployment insurance benefit plus the $600 extra weekly benefit as part of the CARES Act of late March is higher than minimum wage. So the incentive there, if you're optimizing for short-term cash flow, the incentive there is to take the unemployment insurance rather than go out and look for work. But that federal unemployment insurance will run out at some point. State unemployment insurance, depending on the state, goes on a little bit longer. In New York, I think it's 39 weeks. I can't speak for the rest of the country. So that's a short-term optimization. And at some point, I think as the labor market begins to recover, some of those people making that short-term optimization decision will realize that some of those jobs that right now are open may not be in 2 or 3 months' time as people go back to work. So it may slow down the recovery. It may unintentionally slow down the recovery in the labor markets. I concur with that.
One other question from the group, I hadn't thought about this, is are companies that receive the payroll protection plan funds and then using it to pay folks, can you see that? Can you tell at all if that's helping affect this trend down?
Yes, I think it is, because if you remember, this trend that you're looking at here, the peak in that weekly initial claims was the third week of March. That's the week before the CARES Act and the payroll protection program passed. And as part of the guidance around that, the Small Business Administration said, of course, if you use this paycheck protection program loan, that's hard to say early in the morning, to retain staff and to keep payroll, then you can apply for this loan to be forgiven. But those people have to remain on payroll. So I think some of those people who may have been furloughed or laid off came back onto payroll, or certainly companies who were facing a likely layoff said, well, now at least I've got a 2-month bridge loan or life preserver. So I think there's no question, subjectively, it's hard to objectively answer that PPP program, which of course was subsequently topped up by Congress to total about $700 billion, has helped to mitigate, not solved, there's no solution, but it's helped to mitigate what otherwise would have been a steeper drop in the labor market.
Great, thank you. I'm going to hold the other questions.
All right, so the next couple of pages, actually, we've just been talking about the CARES Act. You're familiar with this, and if you see the second number on that page, it says loan forgiveness. That's the PPP program, at least round one of it. I won't go through these lines. The only point that I'll make here is that this is not a stimulus package by traditional definition. Because the oddest thing about this whole environment, of course, is that we're actively trying to not stimulate the economy. That's a really weird thing to say, because social distancing is economic distancing. So we're actually only trying to preserve enough of the economy so that when we reopen it, there is an economy to go back to. So I think if this is more of a life preserver or a bridge loan, I do believe that as we get further into the summer, as states reopen, as the economic toll becomes more obvious, I do think Congress will come back with a more traditional stimulus package. And we're at the stage in Washington in which there's a lot of sausage being made. So trial balloons are being floated, wish lists are being created. You're hearing murmurings about a payroll tax holiday, infrastructure plans, which come up all the time, further tax cuts, which come up all the time. So right now we're at that grab bag kind of part of the process, but look for a more traditional stimulus package to follow, maybe even as soon as the early summer. And I think that too depends on the rapidity with which states open up. This was $2.2 trillion. If you go to the next page, Robert, there was a sort of a top up of it, if you will, another almost $500 billion of spending, the biggest part of which was an additional $320 billion for the Paycheck Protection Program. So I don't believe that Washington is done with the fiscal policy part of the address to this economic crisis. I don't think the Fed is done either. If you go to the next page, monetary policy is the purview of the Federal Reserve. And the Fed has a lot of tools in its toolbox, and they deployed them all rather quickly. It's head spinning how quickly the Fed pulled out, dusted off the 2008 playbook, and then threw the whole thing at this economic crisis, starting in early March by cutting interest rates to zero. Again, I won't go through all of these lines, but all of those facilities you see are actions that allow the Fed to participate in financial markets as a buyer of last resort, or in some cases, a buyer of first resort. Third week of March, there was a great deal of dislocation even in the highest quality fixed income markets. It's not a coincidence that a lot of these facilities were put in place on March 23rd. That was an actual day of primary dislocation. This enables the Fed to go in and buy commercial paper, asset-backed securities, corporate bonds, ETFs that own corporate bonds, to issue new bonds, to be a primary player in the bond market, student loans, auto loans, credit card. I mean, it's just almost a menu of everything in fixed income markets in particular. The biggest bazooka the Fed has is the one I've highlighted in yellow, and that's their balance sheet. It's an important distinction, maybe an obvious one, but an important one. The federal government cannot create money. The federal government can spend it. The federal government can borrow it. Only the Fed can create money with the push of a button. They've done so to an extraordinary degree. If you now go to the next page, this is a simple graph of the Fed's balance sheet. And the Fed's balance sheet has grown by $2.6 trillion over the past 8 or 9 weeks. And again, I'll draw your attention back to 2008 and 2009, which is swamped by the size of the stimulus the Fed has put into place here. This sounds like a real kind of inside nuance, but here's how this translates into economic activity. These are the same thing as commercial banking reserves. So by creating $2.6 trillion of reserves, that gives the Fed the ability to go to commercial banks and say, all of those asset-backed securities, all those mortgages, all those student loans, all those credit card loans, we will buy those from you and we will give you cash. Treasuries is the technical thing that they're doing, thereby reliquefying the balance sheets of the commercial banking sector. Now, commercial banks can lend up to 10 times the size of their reserves. They never do. No bank runs that close to the regulatory limit. But theoretically, this $2.6 billion in reserves could translate into $26 trillion of lending. That's 1.3 times GDP. That is a huge number. This is the Fed's way of saying to the banks, we're not going to let this liquidity dislocation turn into a solvency issue. If you've got problems on your balance sheet with delayed mortgage payments, with delayed corporate loans, we are ready, willing, and able to see you through that difficult period so that you do not have to foreclose, you do not have to issue capital, so that we don't run into the problems in the banking sector we ran into in 2008. And so far, so good. As scary as this line kind of is, if you flip to the next page, Robert, the shape of this graph looks very similar to the shape that I showed you for the initial unemployment claims. A peak in the Fed's creation of money in the middle of March, followed by some pretty steep declines in that. What I interpret this as is the Fed taking its foot off the gas a little bit and saying we put a lot of liquidity into the economy, seems to be working. Financial markets have calmed down, fixed income markets in particular. There have been no real bank crises. Let's ease off the gas a little bit and see if our mission is accomplished. There's no doubt in my mind that the Fed would step back on the gas if they have to. But as you see, for the past, what are we up to now, 1, 2, 3, 4, 5 weeks or so, this has fallen quite dramatically. The other tool the Fed has, and then I'll stop for questions as well, is the repurchase market. So the New York Fed in particular goes into the repurchase market. That is a market in which people borrow money literally overnight. And the Fed, by creating money in the repo market, if you go to the next page, Robert, has added to the toolkit by issuing a whole lot of, you see that spike there, same kind of time period, mid-March, a whole lot of repurchase activity. These are hundreds of billions of dollars a day. That has since fallen back to a more normal level. And indeed, there have been some days in which the Fed hasn't had to be in the repo market at all. So I'm not willing to declare that we're out of the woods quite yet. It seems like, I'm going to quote Churchill here, that this is not the end. It's not even the beginning of the end, but I think we may be at the end of the beginning of the economic crisis in terms of the periods of distress and dislocation that we saw a couple weeks ago. Let me just one or two more things, then I'll stop again. One of the things that I think the Fed is likely to keep in place for some time is very low interest rates. So if you go to the next page, this is the Fed funds rate. This is the rate at which banks lend money to each other. That's important because the rate at which banks lend to each other determines the rate at which they can lend to you. So you can see after the global financial crisis, rates were zero for a long, long time. The Fed began increasing interest rates, and then, of course, last year and in early March, reversed course and brought them all the way back down to zero. And the futures market says they're likely to stay there. The futures market is not a crystal ball. It doesn't mean it's right. All that does is say that right now in this environment, the market expects the Fed funds rate, short term, think of them as money market rates, to be zero all the way into the year 2023. May or may not be true, but that's the market's expectation. And it's driven in large part by the next page, and then I really will stop. I keep promising that. There is no inflationary pressure that would prompt the Fed to begin raising interest rates. The red line on this page is the Consumer Price Index, CPI, and it's down to 0.3% year over year. A lot of that's energy for obvious reasons. But even if you back energy out of the equation, the so-called core CPI, so inflation without the effect of food prices and energy prices, that too is growing at only 1.4%. So unless or until there are real inflationary pressures that the Fed feels compelled to respond to, I think we're in an environment of easy monetary policy, low interest rates for some time to come. Let me stop there once again and see if that provokes any questions.
All right, that was awesome. I know you've got some more slides, but I've got a bunch of great questions. So I'm going to hit you kind of rapid fire.
Many more. We're close to the end.
So don't feel like you got to go into detail on these if it's a quick answer. In no particular order. One question was around any chance of negative rates in the U.S.
Well, so yes and no that's a typical economist answer, right? Yes, because market rates can easily go negative, and they already did. So in late March, very short-term treasuries, 1, 3, and 6-month treasury bills traded at negative yields. And what that basically means is that investors were so nervous about what was going on in the world, they were willing to lend money to the US government at a negative interest rate, not much, a couple of basis points, handful of basis points, in exchange for the certainty of the return of the money. In other words, they were more concerned about the return of their capital than the return on their capital. That's a market rate, and that can easily happen just as investors or speculators or traders bid up the price of bonds, and therefore interest rates fall. But that's different from policy rates. Some central banks in Europe and the Central Bank of Japan have experimented by lowering policy rates to negative. So sort of what you see in front of you, the futures market on Fed funds sort of right at zero. You might ask the question, what if the central bank actually said, no, policy rates are negative? I do not believe that this is an experiment the Fed wants to engage in. For no small reason, it really hasn't worked anywhere else, and it's hard to get out of that sand trap, if you will. So I believe the Fed would resort to a whole host of other tools, some of which you saw listed a couple of slides ago, before they resorted to negative policy interest rates.
Any chance of deflation?
Yeah, yes. I mean, you can see it on this graph in front of you. We've been there before. When it comes to setting policy, policymakers tend to focus on the blue line here, the so-called core CPI, rather than the more volatile red line, because oil can be rather volatile. That's an obvious observation. But you've seen periods of deflation in the past. During the global financial crisis, CPI was negative 2%. Core inflation never went negative. So you can't rule out the risk of deflation because you've seen it in other economies. It's something the Fed worries about a lot because although the Fed has a lot of tools in their toolkit to combat inflation, deflation is a little scarier. And if you think about the behavioral psychology behind it, it's easy to understand why it's so scary. If I'm a consumer, if I'm thinking of buying a new car or replacing a washing machine, in an era of deflation, that washing machine is going to be cheaper a month from now than it is today. So I wait. But when I get there, it's going to be cheaper the next month. So I wait. In an economy where 68% of GDP is personal spending, anything that delays personal spending is a vicious cycle, as Japan has seen. Japan has come through 20, almost 30 years now of 0.5% GDP growth. This is why central bankers worry about deflation so much. I think if we ever came close to deflation, the kinds of monetary stimulus that you've seen the Fed do in the past 6 weeks, they would do even more. They would put the pedal to the metal. They would increase this money supply in an effort to push so much money into the economy that people felt compelled and incentivized to spend it.
Are you uh, any thoughts on the recovery being V-shaped or W-shaped, or what key indicators, leading indicators we should look at that would help us see into the future, if you can, on if it would be a V or W?
Yeah, we economists love to apply a letter shape to economic patterns, and I'm not sure there is one, at least in the English language, for the shape of this recovery. I do believe that there is enough pent up consumer demand that as states successfully reopen, you're going to see a big jump in GDP and in spending. So I've been sitting here. I live in New York City, but we're fortunate enough to have a home, an old 18th century farmhouse in upstate Connecticut, where the turkeys wander around the yard and do their mating dances. So, so we've been here since early March and safe. But I've cooked dinner now for 60 nights in a row, and I like cooking. I have young kids; they cook with me. It's a lot of fun. But I got news for you. As soon as the restaurants reopen, I'm going out to dinner 60 nights in a row. Not only for the variety, but because I want to support restaurants. So and I'm going to get a haircut too. So there's this pent up demand that's going to come out. And you're going to see some of this economic data is going to snap back as sharply as it fell off, but not all the way. So you're going to get something that looks like a V-shaped recovery, but not all the way back to pre-crisis levels of activity, say 85 or 90%. And then from there, back all the way to full pre-crisis output is probably a 1 or 2 year slow path as the dislocations actually sort themselves out. Because obviously not every not every business is going to reopen. I think again in New York City, which is an extremely dense area, not every restaurant's going to reopen. Not every mom and pop corner store is going to reopen. Not every dry cleaner is going to reopen. So that full healing of economic activity will look like a V, but from there, a much more truncated and much slower recovery all the way.
And this is a personal one. I last month when the PMI came out, maybe 45 days ago, I was forecasting it would be below 40, but higher than 35. And then the PMI comes out a week or two ago, and it's low 40s, much better than I was expecting. Are there pockets that are doing well, or do we have further declines that will be represented in certain financial indices in April? Why the mixed bag of financial information?
Well, I'm not sure it's mixed. What you're seeing in the Purchasing Manager survey is a reflection of this theme that we see in a lot of data, that as painful as the current circumstances are, they're temporary. So the PMI survey is a sentiment survey. It's not a measure of economic activity like GDP is or like retail sales. So if you are a purchasing manager and you get that phone call, you go through the sentiment survey, you may say, yeah, life sucks right now, but I'm not concerned with the here and now. I'm focused on getting my business back up by June, July, August, September. And actually, I'm pretty optimistic about that. So I think you're seeing a sentiment and a confidence that although the path and pace of reopening and the path and pace of recovery may differ from area to area, we are headed in the right direction. Now, that is both an opportunity and a risk. And the biggest risk, and maybe the most obvious risk, is what if some of these states begin to accelerate their reopening and discover that they did so prematurely, that they have to take a couple of steps backward? I think this is actually highly likely. The question then is, what does that do to consumer sentiment? What does it do to business sentiment? What does it do to labor sentiment? What does that mean for the summer? So although I talk a lot about turning the economy back on, I'm increasingly convinced that's the wrong choice of words. It's not flipping a switch as much as it is opening a valve. So you open the valve a little bit, you open up the beaches, open up drive-in theaters, whatever it is in your own state, and then watch and you wait and you see if you can do that safely. And you may have to close that valve back off a little bit as well. So the good news is people seem to be looking beyond the current economic distress. The markets are certainly looking beyond the current economic distress. The bad news is they may be over-optimistic.
I've got a bunch of the questions I'm going to hold, and so we can continue through the slides.
Yeah.
And if we have time, I'll ask you the questions.
Okay, that's a good segue. So just a few slides left. I just want to touch on financial markets because that's important for a lot of our clients. Everybody on this call has 401ks or IRAs. So one of the things that has puzzled people the most is how the market, the equity market, could rebound so strongly when the headline news flow is still so depressing in many ways. And it's dramatic what's happened. So this is just a graph of the S&P 500, the large cap index. The peak there is February 19th. From February 19th to March 23rd, the market dropped 34% in 23 days. That's never happened before. That's truly unprecedented. What's also never happened before is that in the subsequent 33 days, from March 23rd to today, the market's up 31%. That too has never happened before. So, I mean, there's your V-shaped type recovery. Of course, you all know down 34% followed by up 31% does not get you back to where you started, obviously. But it's remarkable to me to think that as we sit here today, still kind of in the middle of this thing, still with so much uncertainty on the table, the S&P 500 is down about 8% year to date. And you can see from this graph, if you draw a line backwards, the index, the equity market overall is kind of back to where it was in the summer of last year. So year over year, flat. What's even more remarkable is that the NASDAQ, which is an index that comprised mostly of larger technology stocks, is actually up year to date. In the midst of a global pandemic, that index is up year to date. So if you go to the next page, this is the question I get asked the most. How can that possibly be? Three answers, and they're not mutually exclusive. The first of which is the market is a forward-looking mechanism. Financial markets always are. Financial markets are not priced based on today's headlines. They're priced based on what they expect headlines to be 6, 12, 18 months down the road. Now, of course, they don't know. There's no crystal ball. So it's about directionality. So as long as markets can conclude, I don't know what the future holds, but I'm pretty confident that whatever it holds, it's better than it is right now. Every day we're closer to a vaccine. Every day we're closer to reopening. Every day we're closer to real good therapies. That change in sentiment alone is enough to drive the market higher, particularly when you think of where we were 6 weeks ago, building field hospitals in Central Park and talking about economies being closed for a month and a half and death tolls in the millions. The narrative today is much better, and that alone is enough to reprice equities. At the same time, second bullet point, the actions of the Fed matter. The market's a discounting mechanism, then the discount rate is really important. And the discount rate, call it the Fed funds rate for lack of a better one, call it corporate bond yields, whatever you want to call it, is lower than it was 6 weeks or 8 weeks ago. When the Fed eases monetary policy like that, and by the way, pumps $2.6 trillion additional dollars into the financial system, that money has to go somewhere, and one of the somewheres it goes is financial markets. So you may have, point one, a fundamental improvement, further exacerbated by, point two, a tailwind of liquidity. Having said all of that, point three, and we've touched on this already, market could be wrong. The market could be celebrating this fundamental change in the narrative around the healthcare crisis, and could be celebrating the fact that we're getting closer to reopening the economies without fully appreciating how hard that's going to be. I think in retrospect, we will look back and conclude that shutting down economic activity was pretty easy. Just wherever you are, stay there, or get somewhere and just stay there and do nothing. It's hard to implement. That's an easy thing to say. But reopening, state by state, city by city, municipality by municipality, 2 steps forward, 1 step back, the market may not fully be appreciating how messy that will be. That's a risk going forward. Last slide, looking forward. And I'm actually quite excited about this because I think it holds some opportunities. What does life look like after COVID-19? Whatever that means. When we get back to normal, whenever that happens, what does the new normal look like? As an investor, as a strategist, I find this an interesting thought exercise, and I actually find it quite inspiring as well. I think in a lot of cases, what we're seeing is that trends that are already underway will likely accelerate. Households were already raising their savings and deleveraging. There will likely be more of that. More consumption at home. People may either be worried about going out to a movie theater, or they may say, you know what, family movie night is a lot of fun. Let's make that a Friday night tradition. You may also see an acceleration of the de-urbanization that's taking place. Dense urban areas have less appeal now than they did 2 months ago for maybe obvious reasons. Anybody who's been trapped in their one-bedroom apartment in New York City or Boston or Chicago or Los Angeles for the last 2 months and has been thinking about moving to the suburbs is really thinking about moving to the suburbs. At work, supply chains are likely to be reordered. I'm sure some of you are dealing with this right now. We have a client in the greater Philadelphia area who discovered, kind of new, but discovered that they were reliant on a sole manufacturer of a critical input element based in China. They're moving that supply chain back home, or actually moving to Mexico. Mexico could be a big beneficiary of this. More remote working, a greater use of technology, and less travel. These aren't radical changes. These are at the margins. For example, I probably travel 150,000 miles a year visiting clients. I probably won't do that anymore. I'll still travel 100,000 miles, but WebEx and Zoom and those platforms will be a good substitute for that. And then school is the really interesting thing. I sit on the board of a number of schools, and what's really interesting is that if you think about it, colleges in particular are like cruise ships. People come from all over the country, all over the world together in close proximity with each other, and then they leave and they scatter again. How we get back to school is a really tough issue because, of course, particularly for school-age children, that determines how their parents get back to work. That's one of these messy areas that is yet to play out. Fortunately, as we sit here in mid-May, we're on the verge of having a couple of months at least to try to figure out how to either go remote or part remote. Maybe students at the college level take gap years. They don't go to school for a year. They do an internship, or they travel, or they do a mission travel, something like that. So seeing how this unfolds will be interesting. There will certainly be some companies who not only survive this period, but thrive this period as well. As an investor, as a strategist, I'm sort of looking to that other side and the silver linings that I think all of us who run businesses are going to be able to find in ways to improve our own efficiency and productivity. With that, I think, Robert, I think that's the last slide. I think the last slide is just my contact information, but happy to take whatever questions. And my contact information is on this last slide. If a question occurs to you after we part company, don't hesitate to reach out to me or reach out to my colleague, Phil Ross, and we'll be happy to follow up with you.
Scott, that was fantastic. We had a bunch of questions. Half of them you covered by just finishing your slides decks.
Okay.
The rest I'm going to hold just because of time. That worked out fantastic. You did a great job. I went a little long in my intro as always. I'm going to hear it from my wife. But your presentation was great. I'm reading all the really kind words about your presentation and the information that you provided. That was fantastic. Well done.
Thanks.
And please spread the word to your friends up north that South Carolina is terrible. So don't de-urbanizate down to South Carolina. The traffic is already bad enough. Go to North Carolina.
Okay. All right. So noted.
And Phil, thank you very much again for partnering with the CFO Council. You've been an awesome resource to me. I highly recommend all members to go check out their website. There are amazing resources and tools available. It's a great private bank, not only for business, but also your boss, if your bosses or yourself are looking for those type of services, I highly recommend. And they have the best hats in all of banking. I will be sending out the slide deck in an email. In the email will also be a copy of the YouTube recording of this presentation and a link to the LinkedIn post that I'll make. Please spread the word. And a great way to spread the word, an easy way, is to like, comment, and share my LinkedIn post. And this was awesome. I enjoy the WebEx a lot. It was a pleasure virtually meeting you, Scott. I've always enjoyed reading your articles or your quotes in the Wall Street Journal and Barron's, or seeing you on Yahoo Finance or Market Watch. So this was an honor to get to talk to you virtually. Thank you for participating.
Thank you for the time. Nice way to start the day.
Bye, guys. Everybody have a great day.